Okay, in part 2 we're going to talk about taxes, everybody's favorite topic. Obviously you know that individuals and businesses have to pay taxes. The income of sole proprietorships and partnerships is typically taxed at the ordinary marginal tax rate of the individual owners, their personal taxes. But corporate income is taxed at a corporate tax schedule. And that's essentially what we're going to talk about here is how do you calculate the taxes for a corporation. Of course, there is two kinds of income. There's ordinary income. For a person, that's your income from your business or from your job. Capital gains is what you get from possibly the sale of assets like investments or mutual funds. A corporation, the net profit of the corporation from its operations is taxed at ordinary income levels, and likewise capital gains are taxed for the sale of assets. So under the current tax law, the tax treatment of ordinary income and capital gains changes frequently. So we're going to make some basic simplifying assumptions just so we get the flow of how taxes are actually calculated. Individuals have a schedule just like this corporate tax schedule. And I think the easiest way to think about it is every dollar you make has a tax, has a cost. And that cost is identified by this column. So for the first $50,000, every dollar you earn is taxed at 15%. So when you make $1, you pay 15 cents in tax. If you made $50,000 in a year, that would be $7,500 or 15% of $50,000. But let's say you made $50,000 and it's now July. So you have more time to make more money. So you start making money over $50,000. Well, you never pay more on that first $50,000 than what you've already calculated. In this case, the maximum is 15%. So if you make $60,000, you pay the $7,500, which is the tax on the first $50,000, and then 25% of anything over. So if it's $60,000, that's $10,000 over. 25% of that's $2,500. Add those things together, you'd pay $10,000 in tax on $60,000 in income. So let's look at exactly how this works. Again, a couple more examples to get the hang of this. We have before tax earnings of $250,000. So let's go back and look at our table. Here's the table. We made $250,000, so it's on this row. So how do you figure that tax? Here's the calculation, the formula. It's $22,250. Now I'll tell you, if you add these two things together, that's $22,250. Plus 39% of anything over $100,000. So here's our formula, $22,500. 39% of the difference. So the total tax paid is $80,750. So once you have the table with the formula, it's pretty easy to do the actual tax calculation. So now let's talk about some definitions though. There are two different tax rates that we can talk about. The first is called the marginal tax rate, and the second is the average tax rate. The marginal tax rate is quite simple. It's the tax on the next dollar that you earn. So at $250,000, if you made one more dollar, you'd still be on this row. This column is the tax for every dollar in that row. So the marginal tax rate at $250,000 is 39%. Oops. So the average tax rate, though, there's a calculation. It's the tax that you earn. Here's tax. See if I can write this. Here's the tax divided by EBT, earnings before taxes. That's the formula. 80,750 divided by 250,000. The average tax is 32.3%. So let's think about this just for a second. Which one of these tax rates is the most important? Well, especially for small firms, we can make mistakes if we rely on average tax. You see here the difference here is 7%. So if you use the average tax in your forecasting for a project, assuming you make $250,000 now, and let's say the next project is going to earn you another $50,000. Well, where does another $50,000 take us? So let's go back up here. I'm at $250. Another $50,000 is still in this row. So each one of those dollars is actually going to be taxed at 39%. But if I'm using the average, I'm only going to use 32%. So I'll be making a mistake in the calculation of my taxes for this next project. So the rule of thumb is marginal tax rate is the tax rate you use for making financial decisions. It tells you the tax on the next dollars earned. For corporations, there's also some challenges with dividends. There's such a thing as referred to as double taxation. And it's kind of simple to explain. When corporations make profits, they pay taxes. When corporations distribute those profits to the shareholders of the company, their shareholders pay taxes. So shareholders, because they own the corporation, are paying taxes twice. So that's why for corporations, and for corporations only 70% of their dividend, all right, of all dividend income received, right, is actually going to have some taxes. So again, they're saying you have to have less than 20% of it is excluded from taxation. So here we have, in calculating taxes, again, the corporation is going to deduct operating expenses, interest expense, but not dividends. It creates what we're going to talk about throughout the course is something called a tax advantage for using debt. So here you have two companies, debt and no debt. Both of them expect in the coming year to have EBIT of $200,000. During the year, though, debt company is going to pay $30,000 in interest. No debt has no debt, obviously, and will not pay any interest. So in the end, we end up with two income statements that shows that the difference between the net income is $18,000. Right? $18,000 is the net difference that goes to, that can now, obviously from the debt company, they have less profit to distribute to shareholders. So does that sound like something that shareholders ultimately would like to have? And the answer for this is actually it kind of depends, right? When you use debt, we increase cash flow and earnings per share. So there's more cash that can be distributed to shareholders because we have a decrease in the taxes that we paid. So the tax deductibility of interest reduces the actual after-tax cost. Essentially what we're saying here is that when you have debt and you have to pay interest, since it is tax deductible, the government is essentially subsidizing some of the expense of borrowing. The challenge, though, is non-deductibility of dividends. Dividends paid do not have a deductible nature within the corporation. So if you're a shareholder, which would you rather receive, dividends or interest? Well, if you're a shareholder, you'd rather get dividends because they have a much lower tax than what interest income is. But if you're a corporation, you'd rather pay interest than pay dividends because interest has this, what we refer to as a tax shield attached to it. We also want to talk just briefly about something called what happens with capital gains. And obviously capital gains are the profit that's recognized after we sell an asset for more than what its value is to the company. So we just sold a piece of equipment for $150,000. And we purchased this equipment 2 years ago for $125,000. Now we're not going to look at depreciation because that actually would even lower this. But since we sold it for more than its initial price, we're going to have a capital gain of $25,000. There are special rules for individuals, but corporations are just going to add this all up and include it in the marginal tax rate of the and pay the marginal tax rate for the corporation. That's the end of taxes. We're going to talk and use a lot more examples when we get to the course.